You're good to go.
All right, guys, welcome to our March 26th Pro Member Trade Alert. Today we're going to review how our portfolio is positioned. Take a look at that S&P 500 that's raging higher in the face of a pandemic that's spiraling out of control and record-breaking unemployment that'll likely lead to a Great Depression. So for those of you worried about your puts, I'm not, and potentially we'll double down on that at some point next week as soon as we see this lose some steam, but all the data is still pointing to our exact position being the right way to play the markets. Start off by looking at our webinar teaser. So here's the initial jobs claims. So there's a stimulus package coming through that may help slow down the unemployment rate, but the Fed Bullard is sort of laid out the path towards 30% unemployment rate in the near future, which is actually worse than we had during the Great Depression. And this quite likely can turn into a worldwide phenomenon. Now, again, I do believe there is one solution and only one solution to get us out of this mess. And that's essentially, it only works if the entire globe does this at once. Okay, but the strategy I believe that gets us out of this mess that, and there will be no escaping this strategy. It's well documented. It's proven to work. It can work in an isolated area, but if we want to really resume global e-commerce and get back to normal, it really has to be a coordinated world effort. And that strategy is a hardcore lockdown, not a we trust you lockdown, for no less than 30 days, but I would argue 60 days would be better, followed by everyone re-emerging into the world with a lot better understanding of how viruses spread, wearing masks, wearing eye protection, and then having a lot of sanitation everywhere at all times, because this virus is surviving on hard surfaces for weeks at a time. So that's the bottom line. That's the solution. And we'll see how long it takes humanity to figure that out. But I do believe this will this virus will essentially put the economy on its knees, begging for a solution here in very short order, as well as Trump and every other leader. So as badly as they'd like to get everybody back to work by Easter, I think by Easter, this will be getting into a much more horrific scene in the States, as we're several weeks away from that. And by then it should actually be 10 times the daily deaths as we have currently. Now we have some quasi lockdowns in place that should help slow down the growth rate of deaths per day. But I don't think it'll be nearly enough to get it to flatline. The day after we do a hardcore lockdown, that's really stopping people from getting out of their houses, not just requesting that they do that. We probably have 30 days before that would turn the death growth rate from growing daily to flatlining, which would be the right step. So we got the bad data on the unemployment. Stocks are shooting up higher. What a joke. And again, the basic idea here is if Main Street is closed and Wall Street is open, that's a recipe for disaster. So we got some stimulus. We've got some hedge funds trying to get the market up higher, going out publicly talking about it. But I really don't think it'll last. So
it's amazing seeing that circus. Sorry, Jason.
No worries. Yeah. So let's review the trade alert, and then we'll look at questions and some charts and some data. Okay, so we sold the 327 TLT call. No new positions today. I essentially want to see the stock market stop rallying so hard, and also I'd like to see how the treasury market's going to deal with this stimulus? How fast are they going to sell the debt? Is it going to have any short-term fluctuations on yields, or are we just going to slowly march higher in bond valuations and lower in yield? And so it's interesting to see these just massive stock rallies having almost no effect on our TLT position. So that's really the giveaway as to what's really going on. Take 1 trillion of these and call me in the morning. So value of the dollar is going to go down as we continue to dilute it. And that dollar index has dropped below 102 to 99.6. So that is showing that some of the stresses in the currency markets are finding some relief today with all the printing. So let's review how our portfolio is positioned, and we'll go from there. So everything's based on blocks of $75,000. So again, if you have 150, you'd multiply all these sets by 2. If you had 300,000, you would multiply all these sets by 4. So the first step is to understand that we have per $75,000. Let me actually go like this. We'll zoom in on this. Oops. Okay, so the first part of our portfolio per $75,000, we have 30,000 earmarked for our Monday, Wednesday, Friday trade alerts, which we would normally own the SPY ETF. But currently we own this set of put options, which act as the foundation, the concrete that's going to give us a strong foundation to build our house, which is going to be a set of ETFs soon as we believe a bottom has been reached in the stock market. And clearly, I don't think we're anywhere near hitting a bottom. Now, S&P 500 has been raging up higher. It's done this recently, and this is typically done ahead of bad news. So they try to pump the stock market higher, let insiders, which is primarily the huge equity holders running these large corporations, they're trying to get out and load up on bonds. That's why we're seeing the bond market barely budge at the face of the stock market rocketing higher. So bond market's not buying it. And again, we got a lot of funny money in the system, which I believe will quickly run dry as people are getting laid off and starting to sell their stocks so that they have money to survive with. Per $75,000, we currently have this set of long put options. They're all down about 50% currently. So when I first put on the position, this was about 7.5%, just under that total risk to the portfolio. So right now in my total portfolio with this set of positions, I've lost no more than 3.5% of my total account value. But again, I'm not worried about it at all. It looks like we're entering a period of great pain worldwide for equities markets because of a situation. Everybody's scared to go out. They're getting unemployed and laid off, and the cost of goods will rise as all of this mess makes it more and more expensive to hire labor. Okay, so this is again the set of 5 options we have, and we have a lot of time. We have June 19th, September 18th, March 19th, 2021, January 21st, 2022, and March 18, 2022. I may double down on this next week if we're still not crashing at that time. For now, this is a great set you can buy at half off if you've not yet purchased these puts. Now, again, this lays the foundation to give us the confidence to buy equities and hold equities into the future. So that's really the setup for Ernest says, I don't understand why or how the stock market is going up so dramatically. So yeah, it's a short squeeze is lot of people essentially had to cover their puts. And then we had a bunch of buying come into that. Simply put, I would call it market manipulation. Obviously, if GDP is going to crash and everyone's going to get laid off, stock valuation should be going down and not up. So there's going to be a lot of manipulation in the markets when massive amounts of capital are just bailed out for free into all these different sectors. But the amount that was printed, or at least made available, essentially $6 trillion, is only a fraction of the value of the stock market. And we start seeing people have real estate crash because no one's paying rent, when we start seeing retirees cash out their stock positions, and as we start to see the bond market hog all the resources of the economy. Bottom line is I'm extremely confident in these positions. And this is really what we need to have confidence when things do get turbulent again. I'm looking for the VIX to spike above 100 to start selling puts against those 5 ETFs we're interested in getting involved with. And again, those are going to be healthcare, biotech, medical device, e-commerce, and a military defense related set of ETFs. I would guess that at the same time we're selling this put right here, we would start legging into that position potentially. And then we'll start letting go of these positions if the crash does go that low, which I do believe the timing on this is being severely underestimated. In fact, the stock market rally that we're seeing today is pitching that we're back to work by Easter, which I think will be a huge letdown and potentially leading into the next big leg down in the market. Okay, so that's the first part of our portfolio. Again, you can get into this for half off today if you missed. If you do have the position, I wouldn't add to it today. I may add to it next week if we don't start a descent sooner than that. Okay, so that's part one. Part two, again, based on per $75,000 total to invest, we have another $30,000 earmarked for purchasing the TLT ETF. Now, because the TLT has gone up, that would be like 185 shares. I'm overweight and endorsing 200 shares of the TLT per $75,000 to invest. So it puts you above 40%. Now, on top of that, we have two sets of options per based on our TLT position size. So you'll be slightly over 40% by having 200 shares of the TLT per $75,000 invested. This is the set of call options and put options we also have. So we have two groups. One group is based on 100 shares of the TLT. So we have the put option, which is expiring 4/17 and is the 145 strike. So that's, again, really our worst case scenario in our portfolio would be another TLT implosion. But I don't suspect that will happen because I think it was really caused by the stock market and oil market creating margin calls. And so I'm less concerned about the new supply of treasuries being issued and the threats of China selling their treasuries than I am worrying about a TLT sell-off in the face of stock market sell-off. So I think if we do get another vicious drop in oil and stocks at the same time that investors are unprepared for, especially these big risk parity funds, then I think we'll see our TLT going up and realize this could be a risk of a sell-off again, like we saw last time, not because the TLT is the wrong position, but because people are having to liquidate it to cover margin calls. So if you're new to the program, I think this is still a good put option for some downside protection, but it is quite far away from the trading price currently. So it'll be limited protection. If you want to add that I do like that as at least some downside protection. And if you already have it, we're still holding that just in case. So the next position we have is the 2021 January 15 170 TLT call. Again, we have one of these per 100 shares of the TLT. This is our most aggressive position. And again, expects that the TLT can get back to that 180 level to take profits on that. Now, the next set of call options, and again, we did sell only the 327 today for a nice gain. These we have half the number of call options. So per 200 shares, I only have one of these call options. And that's the April 3rd, 157 call, the April 17, 163 call, the May 15, 157 TLT call, and the June 19th, 160 TLT call. So again, I have twice as many of these as I do these call options right here. Now, why is it different? This was based on our SPY position, which has half as many normally as our TLT. So again, this was designed to take a lot less risk and slowly limp into these positions, as timing can be the most difficult part of playing the market. Now I do expect to add positions likely next Thursday into the July, August, September months. So why am I waiting? I do want to see how the Treasury is going to go about selling the $2 trillion the government has just appropriated, and see how the market reacts to this dramatic increase in supply. So that's the one thing I do want to see. And plus, I'd also like to see the stock market start to slow down and even start to get some downside action, which is obviously very bullish for the TLT. Until it goes too far. We did learn that if the stock market does crash at too fast of a pace and oil crashes simultaneously at too fast of a pace, that this can end up with the TLT having to be liquidated to cover margin calls. So we'll be careful about that this time around during the next pullback. Now, per 200 shares of the TLT, I also own 400 shares of GDX protected by the May 15, 23 GDX put. Now, our hope in this position was that GDX would go up more than the cost of our put. So today it is at 25.70. And so it's essentially paid off the cost of the put, making a small profit today. And anything between now and May 15th will be pure profit. So I'm not adding to that position. I'm not selling my put, I'm just letting it sit there and do its job. In addition to the 400 shares of GDX per 200 shares of TLT, I have one GLD call option. So again, for every 400 shares of GDX, I only have one of these GLD calls. So a very small position with not a whole lot of time premium. We have the April 9th and April 17th 158 GLD call option. Now, my only concern with this precious metals position in general is that I do believe the central banks want to try to push capital towards the bond markets. And so they could quite likely dump spot gold into the market rapidly every time it gets too expensive, to create volatility and punish investors who are trying to overposition in the gold market. So that's the big risk, again, is that despite all the money printing and the super low rates and the risk of inflation, everything's really lining up perfectly for gold. The big risk is still that the central banks hold probably 99% of all the gold in the world and can easily just dump gold at the whim and then buy it back as people get scared and crash. So I hope we can get some sell-offs to add to our JDX position and to buy some new GLD call options. For now, I'm just holding these positions as currently the gold market's having some strong momentum, and perhaps they will allow it to spike to new highs, attract a lot of speculators before they try to tank it. And so I think we're going to have this constant battle of everybody knows that gold is the right decision, but the central banks try to do everything they can to prevent that position. So I think smart investors will be sitting there buying every crash and slowly trying to take the gold away from the central banks. And that over time, this will be something like a pressure cooker that explodes to the upside. Just timing and risk management will be critical in this position. So right now with the married put from the entry point I had, plus those two long call options, which I think are worth the risk for reward today, if you do want to add those, it brings my total risk to somewhere around 2 to 3%, but even less so because now we're up in that position. So I'm not taking a ton of risk yet in the gold market. So I like that oil's cheap. I like the gold miners because I think spot gold is going to slowly but surely rise in value. And I like betting that spot gold does eventually turn into a fight between the central banks. So I think eventually we'll have the central banks start to turn on one another and start trying to hoard gold as this money printing gets more and more ridiculous as we realize we can't really stop the core fundamental problem without a hardcore 60-day shutdown and reemerge with masks worldwide. Is really the only solution I've found that makes any sense. Finally, we do have a put option for emerging markets that's up several hundreds of percent. I wouldn't add that today because you do have quite a bit of exposure to the downside in equities from our SPY put options. How's our portfolio hanging in there? We have some drawdown. So in the boot camp with the QQQ put and the SLV call option, you're flat for March. If you're not following the boot camps, you're down 2.9%. We lost some huge gains in the TLT that were sitting in our portfolio earlier in the month. I do expect those will pay off. It's unfortunate we didn't take profits when we could have. So hopefully we'll learn from that lesson and take profits a little bit earlier in the next big surge in the TLT. Although in general, my expectation is a sharp, vicious crash in equities in the coming months as really the disease is going to put us at our knees and force lockdowns and crush GDP, push unemployment to much higher levels. So I think we'll still see a slow grind in the TLT as we have this massive increase in supply. And the good news is as the supply side does become more and more important to the economy, we should see less and less volatility, and the Fed will have to carefully protect all the people buying up these treasury products. So look to expand our TLT position next Thursday into future months in terms of call options. 1, 2, on the next pullback in gold, I'll be most likely inclined to buy not these short-term GLD call options. I'll probably be looking at some leaps and slowly building into longer-term GLD call options as we slowly but surely increase our gold miner position. And by slowly but surely, I'm talking about over the course of a year and not over the course of weeks or months. So let me go back up and summarize this one more time and then go into Q&A. Okay, so today I sold my 327 TLT call and I made no other position changes. Everything is based on a block of $75,000. Per $75,000, I own this set of put options. This is going to act as the foundation to build our house. The roof I equate to the bond market. So we have our roof well built and that's set to jet. We have the floor, which is the put options. We're waiting to put in place the walls. Right now, our walls are made out of cash. We're going to replace that cash with healthcare, biotech, medical device, e-commerce, and military-related ETFs, probably in a period of 3 to 6 months. This will likely be when the VIX has popped over 100, and we'll start off by selling puts against those key assets and then eventually flipping into a long equity position. These put options not only can generate profit during this period, but will also act as the hedge so that if we do have a buy order to buy equities, we know that we have downside protection, protecting us against further downside. So I do anticipate buying ETFs as they're crashing. So we'll be going against the momentum, expecting that it may go further down against us before popping up. So getting the exact bottom is difficult, but I do anticipate getting us into these equity positions in US equities in the next 3 to 6 months. On top of that, I'm also looking at some US oil and gas companies, but that may be even further down the road before we enter those positions. I think the first assets that'll be worth buying will be in 3 to 6 months. And again, it'll be healthcare, biotech, medical, e-commerce, and military related ETFs. Okay, so per 75,000, I have this block of put options. I could add to this at some point next week if the market does continue to travel higher against all the negative economic data that's pouring out at this point in time. Per $75,000, I also have 200 shares of the TLT. That brings me to just above the target 40%. And I like to have 200, not 185, because this allows me to protect my position. Every 100 shares, I have the 145 TLT put expiring April 17th. And I also have one January 15, 2021, 170 TLT call. That's by far our most aggressive leveraged position. And again, this is a ratio of 1 of each of these options per TLT block of 100 shares. Now, this block of TLT call options, I have half the quantity. So per 200 shares of the TLT, I only have one of the April 3rd, the April 17th, the May 15th, and the June 19th call options. Again, all of these positions are great to build today if you're missing any positions. So again, this does mean I have twice as many of these two options as I do the other block. Next Thursday, I anticipate adding expirations potentially into the July, August, and September months. What I'm waiting for is, again, to see some weakness in the stock market, as well as I want to see exactly how the Treasury is going to go about selling this $2 trillion and what impact that may have in the short order in yields. So that's a good reason to just pause and wait. So at some point next week on a Monday, Wednesday, Friday trade, I might add to our puts. And next Thursday, I do anticipate adding to our TLT call options. Now that could be delayed an additional week if we're not clear on what the Treasury's plan is to auction off this $2 trillion stimulus plan. Per 200 shares of TLT, I also own 400 shares of the GDX ETF. That's your gold miners. And I have that position protected with the May 15th, $23 put. That's called a married put. Helps limit our downside risk. And again, that's 400 shares of GDX per 200 shares of TLT. I have one put option protecting every block of the 200 shares. In addition, For every 400 shares of GDX, I own one April 9th GLD call and one April 17th GLD call. Now, what's the difference between GDX and GLD? GDX are primarily American Canadian mining companies. They have a great business model and a tiny market cap relative to the total market cap in spot gold. So I like to own this asset because I think it has great fundamental profitability for the foreseeable future. Low oil costs makes mining gold cheap, and the demand for gold is slowly but surely rising. So I love owning the miners as their business model really makes a lot of sense. Funny that Gunlex sold his GDX position right before it broke to new highs. And again, this is a position I do really like and will continue to expand upon as time marches on. And again, I'm thinking in the course of a year, slowly building that position, not in the course of weeks or months. So we have a tiny GLD call option, probably still a great trade today. If you don't want to place it, I wouldn't worry about it. In the next severe sell-off in gold, which will potentially be correlated with stocks, which is odd, but seems to be the case, I would look at placing new GLD call options with much more time premium. I'll probably be looking at 2-year leaps as we reemerge into this position. And again, it'll likely be during the next major sell-off in gold, which I think the central banks will do to try to prevent people from hogging all the gold as they want to do that. So GLD is something like a fractional reserve bank for gold. They have only 1/10 the gold that's represented by their assets under management. And there's an odd relationship with JP Morgan and HSBC, where they have a large short position on gold. So the scheme that they seem to have is to let gold get a lot of momentum and ramp up, and then they dump gold into the open market and cash out their short position and then let it rebuild over and over again. So I fear that is the life cycle to be aware of for gold, as really doesn't provide value to economies if everybody's buying gold. It's really, you could say, a selfish investment. So the central banks want to hog it all for themselves. They really want investors to buy two assets, equities, if you're super uneducated. And if you're slightly educated, then they're trying to push you towards bonds. And that's for all the big banks and central banks. So that is what I expect to see for gold in the long term. Now, if you have the emerging market put in the next leg down, which I think will be in less than 60 days, I will look to exit our put option on emerging markets. I may look at a put option on FXI next week, as I do think we're going to potentially see Chinese specific securities outlawed by America as we look for who to blame for this mess, which I believe will be placed solely on China. So far, the two powers are pretending to be relatively in a period of truce, but their military propaganda commanders on both sides have been striking blows on press releases and for China on Twitter, which is interesting that they're allowed to put all their propaganda into US media while we can't do that to their media, obviously. So I don't endorse anyone taking that put, but look for an FXI put option next week. Now, what happens if FXI goes to zero because it becomes outlawed? I was wondering, would we get the value of our put? And the answer is yes. So you lose the premium you paid for the put, and you get paid out the full strike. So if you think that there's a risk of FXI just being completely blacklisted, then we'd want as high of a strike as possible, or at least at the money versus an out of the money put, as that would allow us to potentially get a very, very large return on that. Okay, so that's a review. We are oh, thanks. Okay, let me look at questions in the chat box, and then we will take some questions on the mic. Okay, so yeah, start off by posting any questions in the chat box. Okay, so Scott says, it's the May 17 TLT put meant to be protection with our ETF. Yep, so this is downside protection that we bought as the TLT was crashing. So if you don't have that, it does provide a little bit of assurance and protection for the next several weeks, but it's pretty far out of the money at this point. So we had TLT go as low as 139 on us. That thing was providing value, and now it's worth very little. If you want to put that on, you can. If you want to write it out until I add new protection, I think that's reasonable, as that won't provide a whole lot of protection at this point. Cole Lee says, what do you envision as a time frame for the TLT? I think TLT will rise until we're done paying off the stimulus, which I think they're just getting started with the stimulus plans. So there's $2 trillion we have to raise, and it's got to be a profitable investment for that $2 trillion that's coming in. So the bond market's primarily paid for by big banks, big hedge funds. Really a highly educated, sophisticated investor understands the bond market, and they're not going to lose money. It'd be like shooting yourself in the foot. So I think that this is probably going to take 1 to 3 years minimum for them to raise all the funds required, and that we'll have a slow grind up that entire way, financed by quantitative easing. So yeah, it's going to likely be a slow grind. Ernest says, I don't understand why the stock market is going up so dramatically. Yeah, it's market manipulation. My best guess is it's allowing insiders to get out. There's no way they could sell all their stocks, so they want to sell as much as they can. And the giveaway is that the bond market's not budging. So insiders are selling to funny money accounts, which are the $4 trillion that the Fed has given out. So where's that money going? I would say it's mostly most of the money that's been relieved by the Fed is going into corporate bonds like LQD, which is allowing corporations to buy back their own stocks, and they're buying it from the CEOs who are just getting out as fast as they can. So I don't think this will be long-lived. Steve says, I believe your strategy is right, but timing is suspect. Can you help on that? Yeah, I might double down on this position by next week, Steve. So highly confident in the trades. And yeah, that was quite a rally in the last 72 hours. So all of our positions are half off on the puts now. Jeff says, how high does the SPY go and buy when before it goes back down? Well, I believe that it will crash, and I think it'll crash before Easter. It's my best guess. Either before Easter or around Easter, when Trump has to tell everyone that we're not going back to work. Okay, let's see what else. Okay, Mike and Salty says, a few sessions ago, the usual sequence of events. Okay, so yeah, I'll go over that in a second, Mike. Let me see what other questions we have. Okay, Tyler's new, getting filled. Okay, great. Great entry point for you today, Tyler. So you kind of missed the downside and the puts. So that's really, really good for you. Yeah, let's talk about, okay, Jack says when Trump tells everyone they can't go back to work, what if? So the put options will go up as economic data continues to deteriorate and more people have to sell their positions, either just to have money to operate with or because they get scared. So right now we're like on a sugar high. Fed gave everybody a bunch of sugar, and sugar burns fast. So $4 trillion, we'll see how long that lasts. I don't think it'll last very long. TLT is going to go up from a different mechanism than the SPY going down. So we'll talk about that. Okay, so here's the big picture. Oh, let me just get to the real website, sorry. Okay, so the Fed has a pretty specific game plan for dealing with crisis, but this time they're doing it differently. So usually the gray lines are all the recessions we've had since 1955, which correlate with stock crashes. And so their game plan is to cut interest rates. Now, what does that actually do? So, and why do they do it? Why does rate cuts correlate to stock crashes? What's the relationship? And why is that good for bonds? Okay, so we got to go back to this right here. Okay, so here's the sweetheart deal that's going to make the TLT go up. And again, this is correlated to the SPY, but not exactly. So S&P 500 is based on companies generating profits. People want to share in those profits. So it's all based on profitability of a company and expected growth. Okay, so if you think that growth is going to increase, you should be betting up on stocks, or if you think they're undervalued at this point in time. My expectation is that GDP is going to crash much longer than people anticipate, and that the government's going to force society to be locked down for much longer than is currently being forecasted. So we get rising unemployment, we get reduction in profitability, we get supply chain breaking down, we get lots of shops. I mean, it's pretty easy calculation to understand why stocks will go down if we can't get back to work. So right now, everybody's being pitched that we're going to go back to work on April. And if that was really the case, and that this virus was going to be stomped out by Easter, then I'd be buying stocks right now too. But I don't think that's the case. In fact, I think we'll just be, what we've seen so far, I would say, was the trailer for the movie. Now the movie's actually starting, and we're getting to this climax in New York, but what you're seeing in New York is going to start rolling out across the nation. And so the bottom line is it's very negative for stocks and very positive for bonds. So what do we do to get out of crises? So we continue to have crises every approximately 10 years, sometimes less time, sometimes a little bit longer. And the Fed does the same thing every time. They cut interest rates below the cost of delivering a profit from the yield of a treasury. That's really the mechanism that makes this work. So if you have a crisis that can't be swallowed up by an individual bank. So in general, if a bank sees a good company that's had a crisis that it didn't prepare for, that's like their favorite thing. They come in, help out that company who has a great business, but unfortunately they didn't predict some sort of problem in their finances that they can't afford. So they need a loan to survive. So banks come in there and they will issue a loan. And if the loan's not paid off, they get to take over a big chunk of the company. So banks love crises like this. But the crises that we are now entering is so large that no individual bank could possibly afford it. So they have to basically try to do the same strategy, but use the entire US government as the bank. So the US government's going to come in and bail out everyone under the sun through selling bonds. So far they've promised $2 trillion in handouts in one way, shape, or form directly from the US government, not talking about what the Fed's doing all on their own. Okay, so this bailout's really designed to go to the worst of the worst. And it's conditioned with no stock buybacks. You know, it's really for the life support part of the economy. So how does that work? So this is where we want to look at this. Step one, the federal fund rate is dropped to, at this point in time, it's 0. But what's important is that it's dropped below the Treasury yield. So right now, the Treasury yield is anywhere from 1.45 to as low as 0.19. Okay, so step one is to make the cost of money for primary dealers, which is a small elite group of banks who essentially control the Federal Reserve. So we're going to make it free for them to borrow money. Well, what are they going to do with that money? Well, they're going to pick up the Treasury auctions. In fact, they don't have a choice. That's the relationship they have with the government, is they have to fill all the unwanted auctions from the government. So they have to buy all the debt that's not purchased by foreigners through the Treasury auction. So we just promised $2 trillion, and now we have to go raise that money through the bond market. So where's that money going to come from? Well, it's going to come from big banks, and then they can go resell this into smaller investors. So they borrow for 0% right now, and they go pick up a positive yielding treasury. So right there, they're making a guaranteed profit. There's really nothing to lose. The interest rate's 0 and the yield is positive. So that's a great first step for the primary dealer. But what do they do next? Well, the Fed wants to stabilize markets, plus make this a profitable investment for the central banks buying this debt. You know, if you think the biggest banks in the world are going to buy debt for a loss, you got to be crazy, because they control the whole monetary system. Okay, so the primary dealers borrow money from the Fed's repo market at low interest rates using the treasuries as collateral. So let's think about it. I'm going to borrow. They're probably going to end up borrowing most of that $2 trillion from the Fed. So they borrowed $2 trillion at no interest. Then they're going to go buy up $2 trillion in treasuries, which will likely be spread out over the next 24 months, maybe 12 to 24 months. So they're making a profit right off the bat. But then they're going to go loan this back to the Fed in return for dollars at a super low interest rate. That's what the repo market is. So they're going to get to collect the yield plus hold the bond, which they anticipate will be going up in value because yields are going down. What do they do with the cash? Then they take that cash and they can loan it to whoever they like. One of the big borrowers are broker dealers. Broker dealers are coming in and loaning this to folks like Ray Dalio and any other investor under the sun. And they can go speculate on whatever asset that broker dealer offers, from gold to stocks to even treasury products, which is the TLT ETF for our group. So now the primary dealers made money buying the treasury, and they've made even more money using the repo market to create liquidity for the general financial system. So it's going to help slow down the stock market crash, may not stop it, but it is adding liquidity in general to the market, and it's ensuring that the US government's debt is sold. Okay, so as all this is happening, usually there's a carrot at the end of the path so that the banks will hold these debts and eventually get bailed out by quantitative easing. That's when the Fed comes in and vacuums all the bonds as the yields have dropped for a profit. So the banks know they're never going to sell these treasuries in the open market. The Fed's going to buy them, and they have a guaranteed profit. Now, because of just how massive the problem is we're dealing with today, they're actually doing QE and rate cuts at the same time. So this means if anybody has to take a profit early on their investment into US debt, that the Fed will take that off your hands. But the incentive is to buy and hold as long as possible to get the maximum profit. And so probably we'll get near the end of the push in the TLT as soon as the deficits start to come back down and we've filled the debt. Now think about it, our tax receipts are going to be crashing and our deficits are going to be rising rapidly. So the supply side is going to be just dramatically increasing. And that phenomenon just right there is going to push a lot of resources by these big banks into this bond position. So as everybody's fighting over this supply of debt, knowing that they have essentially a guaranteed payout from the Fed, not from the open market, this becomes a self-fulfilling prophecy and just slowly but surely drives these bond yields lower. Now, they may have to push interest rates to negative territory over time. So we'll see if that happens. And we can look at other smaller debt markets, which would likely go into negative rates first to have a clue as to whether that could happen. So that's a big picture of what's going on and why we want to be invested in bonds. Follow the big money. The big money is going to be all loading up on government debt. And it's really a scheme that they control through the Federal Reserve. And there's really no way around it. The $2 trillion has been passed, and the banks are going to make huge return funding this debt. Jack says, could we get a copy of that? Yeah, absolutely. I'm not sure if we could paste all that in here. Oh, I got most of it. Okay, so there's all the links. Okay, Pat says, do you think the SPY will go up for another 2 to 3 weeks and drop? I would be shocked if it lasts another 2 to 3 weeks. I'll probably be, if it's still up by next Friday, I'll probably double our put option exposure.
Can you hear me?
Yes, sir.
I'm wondering, because they just put so much fuel on this fire that it's just going to, everybody's just going to jump on this train, and then it's going to just completely drop out. Like I completely believe that the stock market's going to cut in half again. But I just feel like they're, like you said, they're trying to fake everybody back into the stocks, and they're going to replace, and I think it's going to take 2 or 3 weeks for all the large institutions to dump their stocks, where suckers like the regular buyer is going to be able to buy it all.
Yeah, all I would say is time's not on your side to bet up. That's for sure.
Yeah. Yeah, I'm not going to buy. I'm just trying to understand whether or not I have puts that I would like to close out and then just buy at the top again. I don't want to hold on. I don't want to. And it's not your puts, so I still have the stuff that you have. I'm just trying to
Sure.
figure.
Yeah. So I would,
Yeah.
at the latest, I think around Easter, when unfortunately we can't get back to work, would be the longest I could see this lasting. But I don't think time's on the stock market side.
Okay. And what are the economic indicators? Like today was the first claim unemployment. What are the big news items that the stock market's going to be looking at, as opposed to, because I was looking at number of deaths and all the bad news that's going to happen. It's really the economic.
Well, I think as people become unemployed and are forced to sell their stocks, that'll be a huge,
Right.
huge.
Yeah.
So yeah, all the funny money can support maybe 1% of the population or the market cap selling at a time for a couple days. But if you start getting 2 to 3% to sell at the same time, it's just too much. They can't handle it.
Okay.
So yeah, we were early on the puts.
Yep.
Unfortunately, but I'll be ready to double down by next Friday if it hasn't begun to sell off by then.
Okay. Thank you.
Yeah, you're welcome.
Hey, on as far as significant economic news, you can always look at Forex Factory, and they have a economic calendar of scheduled events.
Yeah. I thank you. It's called Squirrel.
The data we got today couldn't have been worse. So I think it's as soon as they run out of funny money, it's going to crash probably. But yeah, I mean, 2.3 million unemployment claims today. That's just insane.
3.3.
Yeah, 3.3. Sorry.
Yeah.
Twice the average estimate.
3.3 million unemployment claims.
Ready to shelter in place. Bring it on. That's Nancy's.
Yeah.
Yeah, well, I heard.
And this is
read
growing
my,
exponentially. So
read my chat box. You'll see something I heard this morning before the number came out with the.
oh yeah, let me read Karen's piece.
Yep.
I was about to read that earlier.
It has to do also with what's going on with the equities market today too. They set this up.
Hey, and just want to step in and provide some clarity here. So literally, Cheesecake Factory announced that it can't pay its rent starting in April, and the stock is up. Let's see here. The stock is up 11%.
Wow.
So, I mean, do you really need to know anything outside of that, guys? Just hold on.
Yeah.
Yeah.
But
Karen says, I'm hearing rumblings from the same greedy hedge fund guys who set up this rebound today by convincing others the unemployment rate today should have been 4 to 5 million. And of course are now telling the same that emerging markets is the place to be. Yeah. Yeah. Just a little patience. They're going to run out of cash very quickly here.
Yeah, well, they're trying to recoup so that they're throwing everybody in the market so they can go ahead and scalp everything. I mean, this is what they're doing.
Yeah. Steve says we need some technical analysis to have predicted the market manipulation. I don't know about that, Steve. Remember, on Monday, we had limit down in the futures markets. And then they rushed out and gave out $4 trillion. So that's unprecedented. And I don't think
Logic is out the door.
Yeah, I don't think technical analysis would have predicted.
This is bizarro situation for sure. Nothing can. This is just survival now. As you said, they're manipulating, and they can do it very hard and fast.
Yeah, the giveaway is the bond market's not selling off at all. So insiders are selling, buying up bonds.
Yeah, and why is the VIX not really reflecting? I mean, what was the other day? What did I say? market was going down precipitously 1,000 points. It barely moved on the VIX. I mean, come on. You know, there's a lot of things in the market that's broken at this stage of the game. I went back and looked also at a chart from 2008 just to see. I mean, you know, we all just had the V bottom in December of whatever, 2018. All right, that's not happening here. We all know we have this limited time. And when I went back to look at the chart just to see what in the world happened back then, even though this is a slightly different situation, it's still morphing into, you know, obviously a financial debacle. So, you know, we had this terrible down and then we chopped around all over the place with these massive moves, you know, and then boom, another leg down again before we finally started to come back up. And I'm getting the hair on the back of my neck is standing up. I'm just saying, I feel the same thing is going to happen here. Everybody who wasn't positioned correctly is now the big supposed smart money is trying to capture what they can from what anything that's left. And I think everybody's I have a fear. They're all going to go back in, boom, get them again, do it again until we have a little bit more, you know, idea of what's going on. But I don't know. We'll see. I mean, we're either going to chop, right, viciously, and then down, and then we'll finally come back up when we can see the, you know, light at the end of this tunnel, or we're just going to have one more smash. But I just think this is going to go on for a while because they're going to do it until they can't, right? Do something that works until it doesn't. And right now, this is going to work for the ones who lost so much money on the down. So we'll see. That's just my thinking. You know, I'm trying to get the psyche of these people as opposed to my own, you know, reaction to it all. I'm trying to go, okay, what would they do? What have they done? You know, history is telling on how reactions happen and how they manipulate stuff. But when I heard that this morning, you know, they're all excited. Yeah, shoot. Oh, it's not as bad as it should be. It is bad. A lot of people couldn't even make the claims today because their state systems were down.
Yeah.
Right. It's important to note too, funds are less than 10% of the total market too.
Right. So this is all this is crazy.
Okay, Steve Lane is predicting 290 SPY. Wow. All right, Steve, we'll buy some call options then. All right, well, we'll see. I highly doubt it. Okay, guys, let's reserve only questions for the trade alert, and then I got to get ready for the boot camp. If you do have questions related to the trade alert, let's get them out, and then we will go from there. Any trade alert related questions?
Yeah, I have a question.
Sure.
So it seems like your core strategy for the last year has been pretty steady state, and that you've been, you know, you lean in a certain direction, but you hedge in case you're completely wrong. And right now, the way things are set up, you're very heavily weighted or overweighted in one direction with basically no hedge to the opposite side in case you're wrong. That seems a little different than your typical, you know, what you typically have done over time. So
yeah, we're betting on a massive stock crash and a yeah, so exactly the risk parity strategy I believe is broken now.
Okay.
Hey, Jason,
Yes, sir.
I got a question for you on the trade. I'm a newbie and I tried to make the trade to sell the TLT call and it rejected it. So
Buy.
I'm
We're
sure.
only, oh, you're trying to sell your 327?
Yes. So I put it in and the strike price came up as 164. Do I try to sell it at that, or do I sell it at what I bought it for?
You should be able to find the open position and then just go click the close button.
Say that again.
I would just find it in your brokerage account and then click the sell to close. It should just have a sell button there, so you don't have to type it in.
Okay. Yeah, so I tried it twice and it wouldn't, not that the way you're saying, but I tried to sell it twice and it rejected me twice, so I didn't know what I was doing wrong. So,
Well,
all right, I'll try it again.
it sounds like you're trying to sell one you don't have. So I would find the position and then close it from from the interface.
All right, we'll try it again. Thank you, sir.
And if that doesn't work, call your broker for sure.
Yeah, I tried that and they're a little bit busy. So appreciate it.
You're welcome. Absolutely. Tony, please.
Yeah, can you hear me?
Yes, sir.
What if the SPY goes to 300 here in the next few days?
Then I'll double down on the puts by Friday.
On which put?
All of these.
All on the SPY puts?
If we haven't crashed by next Friday, I'm going to double this position.
Good question.
Yep, I would love to see that, Tony and Steve Lane.
Well, as I've told you before, I'm a technical guy, and that's what I see coming up.
Okay.
So
that's
the
fine.
290 is lower than what I came up with. I see 300.
Okay.
Yeah,
right.
and the thing is, guys, no technical person on the planet saw this coming up. Can't measure anything technical when you have an abnormality in the market.
Absolutely. Absolutely. Right. There's certain licenses I'm taking, but we got to start somewhere, and that assumption is made.
Let's just, I don't want to confuse people or make people think that the SPY is going to 300. So let's just, if your concern is going to keep going up, my answer is by next Friday, I'll double this position. But I don't want to make the crowd think that this is going up to 300.
No, that's a good answer.
Highly doubt that. So,
Steve, you want to bet?
No. I don't want this kind of commentary. Okay. Next, any other questions about the trading plan?
Jason, my question is on the template. When you come out with the new template, will you send that out?
Yes, sir. So we just got a new template. We have a minor upgrade, which has all the new ETFs on it. So I'll get you a new copy of that. The boot campers should have that already. And then we're going to have an additional set of features added that are revolving around automated option live quotes to our spreadsheet.
Sounds great. Thank you.
Yep. Yeah, guys. So, I'm well aware of technical analysis, and I don't think time's on your side. So I don't want to have any animosity. Timing's not ever going to be perfect. I'm trying to get the big picture working down the road. And I have 2 years of time premium on these puts. So I'm not concerned about it. And the risk management was a small position, which we can increase if we were wrong. So it's really simple. So I don't want to hear any kind of animosity between our members. The higher it goes up, the more opportunity we have to short it. That's all I'll say. Okay, next question on the trading plan. All right, guys. Well, we have our boot camp coming up in 50 minutes. So for those of you who are in the boot camp, we'll be covering the 2 trades we're in, which is the QQQ put. I wouldn't add that today. but the silver play I do like, and that continues to grow in value. Any last questions before I let you go for today?
Yeah, Jason, will you have the time to review all my position, because I think I'm all over the place on my on my put and on my call.
If you want to email me a summary of your positions, I'll cover that in tomorrow's webinar. Okay.
Okay, no problem. Thank you.
Very good. Very good. Tyler G.
Can you hear me?
Yes, sir.
Okay, so should I be holding my questions for the boot camp, or should I be doing them in here since I'm brand new today?
No, go ahead, please.
Okay, so I'm pretty much just going to start from the top with those fills with the SPY puts.
Okay.
And then I think what I'm curious about is see if I can trouble zoom. Next steps to get the TLTs, right?
So yeah, I'll just kind of go through. So what's portfolio size are you starting at? 75? Okay, great. So you're going to be able to pick up these at half the cost I did, which is great. And again, we're not trying to get timing perfect. Okay. My forecast is stock market's going to be much lower in the future than it is currently. So we want to own puts so that we can buy equities during a crash. Okay, now timing the crash, that's going to be when the big guys start selling heavily and when retailers start having to cash out stocks to pay for bills because they're getting laid off. Okay, so I would say that time's not on our side on the puts, and I wouldn't wait to get that position.
Okay, so, and I should get specifically those strike prices if I see a little bit of value.
Exactly these strikes. So to have a 50% drawdown is really not a big deal when you're looking at making something like 500 to 10,000% on these positions. So I'm okay with having some volatility, and the risk I put into this is such that it covers me for 2 years of downside protection. And again, I'll be happy to double that if we're not crashing by next Friday. So this is your foundation for your house you're building. Your walls are all the cash you have still sitting on the sideline. Okay, the roof is your bond market positions. Okay, the bond market is by far my most high confident trade setup because I don't believe the big banks are going to force themselves to lose money. The bond market's completely controlled by the Fed. And again, I highly doubt they're going to let themselves lose money. So that's why we have such an overweight position in the bond market. Okay, so in the bond market, we have 200 shares of TLT per 75,000. We have one put option per 100 shares at the 145 strike. We have one January 15, 2021, 170 TLT call.
Okay, so I'm getting 200 shares of the TLT.
And then two of these.
Then I'm going to get so 2 calls, 2 of the puts, right?
Yep. And then only one of this set. Okay.
200 TLT.
200, 2, 2. And then these are each one.
Okay, that's pretty self-explanatory.
Yep. Then the last step is 400 shares of GDX. I have one May 15, 23 put per 100 shares. Then I have one of each of these GLD call options. And if I were going to skip anything, I would skip these two trades. But right now, gold's been having some upward momentum, so they may not be the worst. The next time I dabble into gold, I'm going to look for a sell-off and then buy leap options instead of short-term. When I first entered these positions, TLT was approaching 180, and I was miscalculating just how much money we're going to have to raise and how long it was going to take. So I'm hesitant to get super aggressive in short-term moves in the gold market until well after the bond market's been able to absorb the stimulus package that we just passed, which is $2 trillion. So we'll see how fast they want to try to sell that debt. I don't know if they're going to just come out and blast it all at once, or if they're going to just slowly try to sell it over the course of a year. So that'll be.
I heard something recently that the bond auction completed, something like that.
So we watch the bonds right here. Here's what they're selling and when they're selling it. So not yet. They have not raised $2 trillion yet.
All right, so it's pretty much 4-1 shares GDX. So we're getting 400 shares, so it's 4.
Yeah, for every 200 shares of TLT, I have 400 shares of GDX.
Yeah. And then the calls for the GDX.
For GLD. So GDX is the gold miners. That's American Canadian companies. So I really like their business model. They're going to be dealing with probably the central banks trying to create volatility in the gold market. Because the last thing the central banks want is everybody to think that gold's going to make them rich, because then it's going to pull money out of the stock market and the bond markets. Really, the banks want you to buy either government debt, corporate debt, or equities. That's really what the banks benefit from. But meanwhile, what are they doing? They're secretly hoarding gold and trying to make it hard for retail to buy it. So retail likes to buy. Look at today. We get 3 days of upside. Now we got every Tom and Joe, calling for S&P 500 to go to 290. But I doubt that they were predicting that last week. So a lot of retailers are very inclined to go with the flow of the market. They like to bet that whatever's happened in the last most recent memory is going to continue to occur into the future. So you'll see a lot of retailers will love momentum-based trading strategies because they can see the market's going a certain direction and they jump into it. Usually it works right away. And that's just the typical retail investor. They're going to buy into a move, hoping that it continues. And so that's really easy for the central banks to punish, because think about it. They have all the gold, let it spike up, let it run a little bit, let every gold bug out there say, oh, it's time to get rich, guys. We're finally breaking past 1650 on spot. And then boom, they just do a massive dump and they can crash that spot gold so fast. And then they have that short position. We know they have a huge short position on gold that they can cash out. That's JP Morgan, HSBC. And remember, JP Morgan's the same one orchestrating with BlackRock this whole bond shenanigans to raise $2 trillion. So I think the smart move in the gold market is buy the dips and potentially protect downside as we get to elevated. So I didn't yet purchase a new put because we have protection all the way to May. So that's where we're at in the gold, and then that's it. Next week I'll look at putting a new put option, but not on emerging markets. I'm going to go straight to FXI, which I think could potentially get eliminated out of U.S. financial systems altogether, which would mean that we get the full strike, which is a hell of a deal. So we'll look at which put option makes the most sense for that. And that would be a very dramatic measure, obviously. Right now, we're not getting any kind of confirmation that the U.S. is. Trump says, I'm a little upset with China. They could have told us what's going on. We've got Barr going up there, Pompeo, pointing some fingers, but nothing too aggressive yet. I think first we have to deal with our hospital systems melting down here.
And that FXI put is like a long-term put you look at?
We'll see what I look at next week, but expect if we're not crashing by next week, not only would I potentially add to our SPY puts, I would potentially add a FXI put. So nothing to do today on that.
I just trying to
FXI is the large cap companies in China, which I think could be potentially outlawed completely from US financial systems. So that would mean we'd get the strike of our put if it went to zero, which would be huge. We would lose the premium paid on the put and then pick up the strike if that was the case. So I'll look at two scenarios. One, it's not outlawed, their index just crashes. And then two, if it is outlawed, what has the best risk profile for both? Now, emerging markets may not go to zero because that does have countries we're allies with, whereas FXI is pure China. Make sense, all this?
Yeah, it makes sense. I'm just
so yeah, we have no long exposure to equities, and we basically have two different correlated bets. We have direct bet down on S&P 500, but again, this is over a long period of time. So I have June, September, March 2021, January 2022, March 22. So again, I'm not trying to predict that it's going to crash this week or next week, but in the months ahead. So yeah, timing was a little off. Remember, Monday morning, we were limit down until $4 trillion came in and gave us this bounce. So I'll be happy to double down on this by next Friday if we're not showing weakness in stocks by then. Regardless, our TLT position's hardly having any drawdown at all. In fact, it's appreciating in the face of this stock market. So that's really a giveaway that this is a manipulated push up and not something that will be long-lived. So catalysts that I think could cause, I think the big catalyst will be realizing that we're not going back to work on Easter, and we're not going to be packing the churches because the virus will be tenfold what it is in 2 weeks. So I think that's your big coming up in the next couple of weeks. Beyond, of course, earnings collapsing for most of America.
Okay, got it. Thank you.
Okay, great, guys. Any last questions? I would like a little break before the boot camp. We're going to be working on the new spreadsheet and practicing filling it out together. All right, guys, very good. Well, we'll see you tomorrow live. And if you're in the boot camp, we'll see you in 30 minutes.